Hello friends, a very warm welcome. We are getting into the next chapter, that is admission of a partner. So after completing PSR, we would have got an idea, because this admission is nothing but a combination of the earlier chapter of fundamentals as well as Goodwill as well as your PSR. In PSR, what happened that the existing partners, their shareholding changed, and based on that we did some adjustments. What were the adjustments? Number one, there was a change in PSR, so there is going to be some sacrificing ratio and gaining ratio, because one partner is going to give up his portion to the other partner, but the partners are not going to change, they are going to remain the same, and there is going to be sacrifice between the partners and gain between the partners. So based on that, what we did the valuation of goodwill, and then we split the goodwill between the partners in the sacrificing ratio, and then we went ahead with the transfer of general reserve, transfer of P&L, transfer of workman compensation reserve, then transfer of investment fluctuation reserve, and then on the asset side we had revenue deferred revenue expenditure, which is your advertisement suspense account, and P&L debit balance. So these two from the asset side and these four items from the liability side are going to be transferred. And then we had revaluation of assets and liabilities. We pass the entries under revaluation, get the revaluation profit, and then transfer that to the capital. Suppose they are not going to record in the books, then we'll just take the net effect and pass the sacrificing partners entry will pass. So we will debit the gaining partner and credit the sacrificing partners. And then finally we did the capital adjustments. So these are the steps which we follow for the PSR. The steps remains the same for even admission, but the only change here is that we are going to have an additional partner. Okay, so what happens, a new partner is going to join the entity, and what happened, the existing partners, they are going to give up their portion of profit. So ultimately the sacrifice is going to happen from the existing partners. So whatever, let's assume if A, B were there and C is joining for 1/4 share, means the balance 3/4 alone will remain with A and B. That means they have given up their 1/4 share to C. So this is the reason why the sacrificing partners will be A and B, and the gaining partner will be literally the new partner. Okay. So this is one big change compared to the PSR chapter. So if you go to 5.2 page number, you can see the adjustments which is required on the admission of a partner. So the first step is going to be finding the change in the profit sharing ratio. You determine the new profit sharing ratio and the sacrificing ratio, because the old partnership comes to an end and the new partnership starts. So this is the reason why we need to find out the new profit sharing ratio. And then we need to do the second step is the valuation of goodwill, and third step, adjustment of the revaluation of assets and liabilities. Fourth step will be adjustment of deferred revenue expenditure. Fifth step, adjustment of reserves and accumulated profits and losses, and sixth one is your adjustment of capital based on the new profit sharing ratio. So we'll do each of these steps in detail right now. So we'll start off with the change in PSR. You can see that when the new partner comes, obviously then the profit sharing ratio will be new, because earlier whoever partners were there, we call them as old partners, they are going to continue, but the new partner is coming with a understanding that he is going to get some portion of the profits. So now we'll see the first situation when the new partner gets his share from the old or existing partner in the old PSR. That is, what happens over here, the new partner is going to get his share from the old partner in the old profit sharing ratio. So we'll start with case 1, where the profit of the new partner is given, but the sacrifice share of the old partner is not given. So this is case 1. So they have told that the profit sharing of the new partner is available, but unfortunately how much sacrifice they have done is not available. Then what will we do? So first step is that you deduct from the share of the new partner from 1. So like I said, 1/4 is the new partner share, means you deduct that from 1. 1 minus 1/4 is going to be 3/4, and divide that balance among the partners in the old profit sharing ratio. Okay, so like 3/4 was there, so this 3/4 you divide between the partners in the old profit sharing ratio. So this is the first situation. We can see illustration 1. Om and Shiv are partners sharing profits in the ratio 5:3. Hari is admitted for 1/4 share. So when Hari is going to get 1/4, the remaining portion is going to be 3/4. This 3/4 will divide in the old ratio, that is Hari and Om and Shiv were in the ratio 5:3. So 3/4 into 5/8, and Shiv will get 3/4 into 3/8. So and then if you compare all the ratios, that is 15/32, 9/32, and you will get 8/32. How did I get 8/32? It was actually 1/4. To make all the denominators common, I will multiply by 8, okay, on the last ratio, so it will become 8/32. So we'll get into the next case where the share of the new partner is given. Also the new profit sharing ratio of the old partner is given. So they have already given all the details. So in this case, the new partner's profit is deducted from the again 1, and the balance of the profit is divided among the old partners in the new profit sharing ratio to calculate the new share of each of the old partners. So this will give us the new profit sharing ratio. So they have only given the profit sharing ratio of the old partners. Okay, so we'll use that method. Then we'll go to case 3, when the new partner gets his share from the old partners equally. This is very easy. Okay, so whatever answer balance you are going to get after subtracting, you just divide that half, 1/2, 1/2, and you deduct that portion from the old partners ratio so that you get the new profit sharing ratio. So that is there. Then coming to the second situation, so we have done with 3 cases in situation 1. Then now coming to the second situation, page number 5.5, the new partner gets his share from the old partners in a particular ratio. That is, the new profit share will be nothing but whatever is the old profit share minus the profit share which is sacrificed. This we have to remember. So now when the existing partner's share of profit will be reduced from the profit which is profit share given, or the sacrifice in favor of the new partner. So the existing partner's new share of profit in the reconstituted firm is determined by deducting the sacrificed profit share from the existing share of profits. So we'll quickly see illustration 5 on page number 5.5. Naresh and Namit are partners sharing the profits in the ratio 2:1. They admit Nimish for 25% share. Nimish acquired the profit from old partners in the ratio 3:2. So they have given the proportion. So 25% means what? 25/100, which is nothing but 1/4. So now Nimish is going to get 1/4, that is in the ratio 3:2 from Naresh and Namit. So it will be 3/5 of 1/4 and 2/5 of 1/4. So 3/20 and 2/20 is what Nimish is going to get from Naresh and Namit. So now Nimish's profit share is nothing but a combination of these two, that is 3/20 plus 2/20, which is 5/20. When we talk about Naresh, he was already getting how much? 2/3, and we'll subtract this sacrifice portion. So 3/20, so we get 31/60. And when we go to Namit, he is getting 1/3. We'll subtract this portion of sacrifice, which is 2/20, so it will be 14/60. So the profit of Nimish is going to be what? As I told you, it is 1/4. So to make the denominators common, we have to make it 60. So we'll multiply with 15. So it will become 15/60. So the new ratio is 31:14:15. Then coming to the third situation, when the new partners gets his share in a particular fraction from the old or existing partners. So again, this is going to be very similar, where you subtract the old partner's profit share minus the profit share which is sacrificed. So this is the same as which was there in the BSR. Go to illustration 9. Bharat and Bhushan are partners in a firm sharing profits and losses in the ratio 5:3. Bhagat gets his share equally from old partners. So he is going to get how much? 1/5 share equally. Means what? 1/5 into 1/2. Again 1/5 into 1/2 from Bharat and Bhushan. Then Bharat gets his share from Bhagat gets his share from Bharat and Bhushan in the ratio 3:5. So this 1/5 he is going to get in the ratio 3:5. So 1/5 of 3/8. So 3/40. Again 1/5 of 5/8. Again 5/40 will come from Bharat and Bhushan. So we'll subtract this 3/40 and 5/40 from Bharat and Bhushan's share. so that we arrive at the share which is going to be for Bhushan. So Bharat will be getting 22 by 40, Bhushan will be getting 10 by 40, and again we know Bhagat is 1 by 5, so to make it common, 40 will multiply by 8 and 8, so it will become 8 by 40. So this is very easy. And suppose Bhagat is getting a share from Bharat alone, so we have to simply subtract 1/5 from Bharat and arrive at the new ratio. That's very easy in fact. When Bhagat gets a share from Bharat 5 by 40 and from Bhushan 3 by 40. So here simply subtract 5 by 8 minus 5 by 40 and 3 by 8 minus 3 by 40. So now how did I do it was that we have to see the word over here from and off. Okay, whenever we see the word from, we will subtract. Whenever we see the word off, we will multiply. So this is very important. You can see in page number 5.9 illustration, both the situations have been addressed, where if it is a off, we will multiply, and when it is from, we will subtract. So this is how we find the new profit sharing ratio, and when we compare the new profit sharing ratio with the old profit sharing ratio, we arrive at the sacrifice or gain. So whenever we do admission problem or PSR or any of the future problems, first step is going to be finding the new profit sharing ratio if it is not given, and then find the sacrificing ratio or gaining ratio, and then we'll go ahead into the next step. So the next step will be obviously valuation of goodwill, and like we have already learned that the goodwill will be done based on 5 methods. Okay, you have either average method, you have weighted average method, super profit method, and capitalization by average method or capitalization by super profit method. So you apply the methods where which is given in the question, and you'll arrive at that. So what happens many a times, the new partner, because it's an admission problem, so when the new partner comes, he'll bring capital as well as he'll get his portion of goodwill. So when this goodwill is brought, will pass the entry cash and bank account debit to premium for goodwill account. I repeat, cash and bank account debit to premium for goodwill account. And so we can do a combo entry also, because he's going to get both capital at the premium for goodwill, and then this premium for goodwill will get transferred to the sacrificing partners or the old partners mostly. So the sacrificing partner will be getting the portion in the sacrificing ratio. So we'll pass the entry premium for goodwill account debit to sacrificing partners capital account or current account. So this is the portion of goodwill, and then again I will tell one more important point, which is, suppose the goodwill is already existing in the books of accounts, apart from what we did just now, the valuation we did and then we did a transfer. Suppose the goodwill is already there in the books of accounts, then you have to simply write it off by transferring to the old partners. So you will take it as old partners account debit to goodwill account. Okay, you have to just pass this entry, so it will get posted to the capital account. And also it can happen that when the new partner is going to get the premium for goodwill, the entry will be cash or bank account debit to premium for goodwill, and then this premium for goodwill will be transferred to the sacrificing partners, and then sacrificing partners to cash and bank if they are going to withdraw. Sometimes they might withdraw 50%, sometimes they might withdraw even 100%. So you have to read the question. If it is withdrawn, then we have to pass sacrificing partners capital account debit to cash or bank, whatever percentage they are given, or the entire portion is withdrawn. So you can go to page number 5.24, where the goodwill is brought in kind. Then we will debit the asset, whatever he has got, asset account debit to the new partner's capital to premium for goodwill. Then we will transfer this premium for goodwill to the sacrificing partner's capital account, and suppose they are going to withdraw cash for this, then partner's capital account to bank. So this is how we will pass the entry. Suppose the new partner does not bring any amount, the share of goodwill, we will use his current account. So the new partner's current account will be used. New partner's current account debit to sacrificing partner's capital account. Then the last portion of goodwill is going to be the hidden goodwill. See what happens, we have to find out the net worth of the company. The net worth formula is your sundry assets minus outsiders liability, or the capital of all the partners plus the accumulated profits and reserves minus fictitious asset and minus non-trade investments. So we will arrive at the net worth. This net worth will compare with the actual capital. Okay, capital of the old partners and the new partner. We'll compare both the net worth and the capital, and then whatever difference we get, Okay, if the net worth is in excess of the capital which is held, then that is called goodwill. So this is a portion of the hidden goodwill. So you have to get the net worth and compare that with the total capital including the new partner, and you arrive at the hidden goodwill. So this is a quick revision of goodwill. So we'll get to revaluation in the next video.